Our next guest says that the U.S. has become a disruptor of itself in everything from cost structures to trade flow to immigration. And yet, while many economists expected inflation and recession to hit pretty quickly, it really hasn't materialized as expected. But there still is a way to go. And yes, Canada is along for the ride. Beata Karrantzi is chief economist at TD, and she joins me now. Great report that you just put out, and two reports we're going to talk about. And I want to start by asking you about the title. Yeah. Tails we win, yeah. Heads you lose. Yeah. I don't like playing those games, Beata. Why? And you're talking about the U.S. economy. Why the title?
Yeah, I think because they've put in place the greatest amount of disruption to their labor market institutions and everything you mentioned off the top, and yet it's still an economy that's outperforming the peers who are really only absorbing the disruption on the trade side. They're not dealing with all the other aspects that are happening in the U.S. So it really does speak to the construct of the economy. A lot of their growth drivers come off of investment and innovation. And that's where Trump has been quite supportive in policies and further deregulation in the future. The consumer has not done as well in the U.S. economy. So, it depends which pockets you want to look at. But certainly, I think it's being described as resilient, but resilient does not mean strong. So it's definitely absorbing an impact from everything that's happening, but much better than many people had anticipated at this stage.
I want to give credit where credit's due. I have the benefit of talking to you over many periods of time. The last few times I know, you were not one of those who had a recession call for the States, you and your team. And that's not what we've seen so far. But again, you're highlighting here the difference between resilience and strength. And Are we starting to see things to move in that direction now? Yeah,
so I think when you look at what's happening in the job market or what's happened in the first 6 months of the year, 7 months of the year, we had a restatement of the jobs data through a massive revision. It was one of the largest we've had in history outside of the pandemic.
To quote you, job market revisions shatter resiliency narrative.
Yeah. And so we thought, we had it a little bit wrong because while we didn't forecast a recession, we still thought the job market would take a little bit of a hit. Mm-hmm. And we had this narrative happening in the US where the job market was incredibly strong. The revision wiped that narrative away. And what it told us is it's only about 35,000 jobs being created on a 3-month basis. That number for the size of that job market is Canadian-like. So it's quite low for them. They're 10 times size of the economy. We're seeing very low job churn, which means people are not quitting their jobs in search of other jobs, which is usually a sign that you don't have the confidence or there's not something out there where you can skills match to a better degree and more pay. And firms are not hiring to a great degree either. So we've seen deteriorations not just in the job numbers, which are still advancing, so there's not job losses. Mm-hmm. The unemployment rate is still low. People filing for insurance claims is still low. But when you look at it holistically and pull the lens back, there's not a lot happening underneath it. It's just in this trudging along mode. And that does tell us that there's an underlying weakness happening, not recession-like, but certainly many people are saying if this were to continue for another 6 to 8 months, it could push you into that lane.
You talk about in the report, there's a great line here that we have to become, you said, data dogs and sniff every corner for information. And you kind of highlighted a few things in terms of the data, what it's showing on the labor front. What else are you looking at to understand, I guess, the true composition of what's going on below the surface?
Yeah, so the consumer's big. They're the majority of the U.S. economy, and they are a byproduct. What you see on the consumption side is a byproduct of what's happening in the labor market. And we dissected that one a little bit more in our report. We're quite familiar with this narrative in Canada that when you remove high population growth by changing your immigration policy, you remove a stimulus to the economy. In ours, we saw it through the housing market, but also through consumption when people come in and they buy clothing and phones and all sorts of things.
And houses.
Well, the U.S. has taken out, at the border, in terms of how many people they've stopped from entering, about 2 million by the end of this year, we estimate. But more importantly, there's about 11 million undocumented workers who probably don't feel great about going out and spending and gathering and going to amusement parks and restaurants because the ICE arrests are so elevated and rising. So there's an insecurity there. So we estimate that those two channels are probably depressing consumer spending as well. That gets less and less as you go further out, like next year, because you hit a lower level of population growth, but it stays at that lower level. It doesn't continue to decline. But right now, there is a big consumer impact happening from that channel as well. And then we're looking at the inflation data. So there's a little bit of a disconnect in the narrative there. Many people are saying, well, when you look at aggregate inflation in the US, it is definitely better than many people had expected. That is because the service side of the economy has normalized. Remember, we used to have like costs at 8% on housing and other factors. That's come down quite a bit. However, the goods side, which is the side that's being tariffed, is reaccelerating. And that's both on a 3 and 6 month basis. So there's no denying there's some pass-through of prices happening. It's just happening in a very narrow portion of the economy right now. So if that continues to broaden as we expect, the consumers are going to continue to feel it. So we're really focused on those job consumption variables. And then there's always like the investment side that puts the counter argument.
Well, and you touch on this, you talk about the trade deals and how that you talk about your language, they've morphed into the bigger strategy around investment deals.
Yeah, so they started off everybody thinking these are going to be tariff deals. That's part of it. But really there's another intention, which is to get more investment into the US by commitments of procurements, direct investment, of moving activity, or purchases of US exports. And energy supply is a big one. Defense is a big one, defense purchases. And so there's about $1.5 trillion of commitments already made by basically 3 regions, Korea, Japan, and the EU making the biggest. And so even if you only see a portion of that come through, that is an impulse to growth. Many people wouldn't have that in their forecast. We don't have it in the forecast for the US because you have to see when those commitments come through. They're basically commitments through the entirety of Trump's term, but you don't know how they will be staggered and to what degree. A little bit loosey-goosey still. We don't know all the details about the timing from the countries themselves. So there's an element that is an additional stimulus factor that many people wouldn't have thought would have came out of the tariff deals, right?
And does that mean the consumer, if they can tread water, that maybe the stimulus could come in and be a tailwind? Or are you still kind of, when you look further out, is it just lessens the blow?
Well, it's a timing issue because you have the tariffs being absorbed now, either by businesses, and a portion of it is getting passed on. A little bit more will continue to get passed on as the year goes on. But then you have the One Big Beautiful Bill coming in next year with a lot of tax incentives. And so when the consumer's getting a little bit depressed on the front end in 2025 and 2026, you start to see offsets coming through. And so you may not see on net a big movement in consumer spending growth because they start to cancel each other out, but you also don't get a worsening in the condition. And so that's one of the reasons we don't have a recession call for the US, because there's a lot of moving parts in there. And if you just focus on the negative, you probably overestimate the downside.
Beata, the first report we talked about, tails we win, heads you lose. The second report is questions, we've got answers. I know there's a lot of questions out there right now. Given everything we just talked about in the US right now, how has Canada's economic outlook shifted over the last few months, let's say year, now that you're observing what's going on?
Yeah, so Canada's an economy where I thought it would be in far worse situation than where we are today. So like the US, it has a resilient nature around it in terms of the story. Definitely not strong, not as resilient as what you see in the US because the trade side is really getting hammered. But outside of that, we see an incredible strength out of the consumer. And I think a lot of Canadians would be surprised to learn that the Canadian consumer, their spending growth, has outpaced the US significantly.
Really?
By about 2.5 times.
2.5 times?
Yeah, the growth, not just last quarter, but in the last, basically the first 6 months of the year, and even if you go back a full year beyond that. So we like to, be humble about our approach, but in this particular area, the consumer is definitely holding up a good portion of the economy. Now, the second quarter data that was really strong on consumer spending was also the elbows up quarter, right? So we'll see if that can...
Buying my BC and Nova Scotia wine and not the gin from wherever.
Yes, and vacationing and all of those things happening domestically. So it works. You can see it in the data, but we'll see about the sustainability of it. And part of the reason it works is because the job market, although it hasn't been as vibrant as it's been in the past, again, it's averaging about 15 to 18,000 jobs a month when you average it out over 3 months. So about half the pace of what we're seeing in the U.S. for an economy that's 1/10 the size. So that's what I mean, that it's not really firing on all cylinders, but certainly there's pockets of resiliency coming through. The housing market is another one. We've seen several months now of sales coming up, a little bit of price resilience starting to come back in. So basically going back to our traditional Canadian drivers of housing and consumers being the tailwind to the economy. And then the weak spots are being exports and investment. Opposite of the U.S. story, investment is not strong at all. We don't show the propensity to spend in areas of intellectual property and technology and equipment, whereas that's a shining star in the U.S.
Well, the next question you have in your report, which actually I think just segues, is that going to change? When you have Prime Minister Carney, the incoming government, who's been given the mandate essentially to nation build.
Yeah.
Is that enough? Is that a big enough tailwind to really start to finally jumpstart that I think a lot of Canadians have been asking for a long time?
Well, it's not going to make it worse. How about we start there?
That's not very optimistic.
The good news is that, so we have to manage our expectations. So you have C5, and that's intended to remove some of the barriers and speed up permitting processes on projects and other factors. We have the Prime Minister's office creating a list of priorities on projects that could be, shovel ready and positive.
Key personnel to shepherd them along.
Yeah, and we've heard of ports in Churchill and Montreal and other things that look like they can, get moving earlier. All good news. But the reality is that a lot of the information and control of these projects still falls within the domain of the provinces and having consensus and agreement on projects and the movement of them, as well as we have to make sure we have Indigenous consultation processes that are proper. And so as much as we would like to take an 18-year process and drop it into a 5- and 7-year format, it will remain to be seen how much of that we can excel at. Mm-hmm. It will be a big challenge. So we have to manage the expectations on the speed of projects, but certainly the fact that there's lists being created, identified, prioritized, we have companies showing interest in it. This is all positive. Carney himself has indicated that he wants to think through about $500 billion in capital projects over 5 years. That's 25% of GDP. If he could do it, we would be an economy that's unrecognizable relative to where we are today.
He just wants to spend like Canadians in the second quarter. So.
That's right, but on the investment side. So that's a huge challenge. It's ambitious, but hey, why not go for it? Make it a moonshot.
And I guess the defense side too plays into this as well in terms of the nation building, because there's all the projects, the pipelines you mentioned too, but maybe in partnership with the U.S. Maybe not. We're still waiting to hear, but defense spending is a big chunk.
Yeah. So defense spending, the long-term goal is to get it up to 5% of GDP. This year we'll hopefully be at 2% of GDP. So there's a significant amount of spend there. Part of it is going to be dedicated for wages and salaries, so better conditions for those serving in the military and veterans themselves. So that's
stimulative,
positive.
Right?
Absolutely, it is. And then the other part is for the building of equipment and capital, and the technology and the cybersecurity and all that comes with it. So defense is an interesting area because it has not been our stronghold, but when you look at other countries like the US, it has a lot of positive spin-offs in other industries. And so if done well, while you're thinking it's only defense spending, the technology you develop and use in that area can be used in other areas. So it's, the propensity for growth and the optimism around it is high, but it always comes down to execution.
Let's get back to some of the questions. Last two in the report, then I might, if I have time, I'll squeeze one more in there. Given what you're seeing for Canada, again, weakness, we've seen some real strength, but resilience, I'll say, and then it's starting to come down. What does the Bank of Canada do? Is the Bank of Canada done cutting rates?
Yeah, it's quite possible because for them and the way they defined the neutral rate, where they think it's all consistent with stable inflation and jobs, they're already in that range that they've defined. We think there is room for at least 2 more cuts. One on the very minimum, that's what the market has priced in. But I don't think they'll do one and done. If they're going to do one, I always think what is the expression? It's like potato chips. You never just have one, right? Mm-hmm. So I think there'll be a second incoming. And the logic there is that, we are going through an industrial rotation. you end up with capital destruction usually first, and then the creation side on a lag. And so we know there's industries being pressured. We know there's uncertainty with the tariffs that is affecting business cost models. So ideally, you should be running a lower interest rate or a cheaper cost of capital in that type of environment until you can get to the other side, because you need to incent a greater amount of investment to backfill the stagnation or losses that might be happening in other areas. So inflation is also being extremely cooperative. In the last inflation report, we're starting to see better numbers coming in for Canada. The government's removed many of the reciprocal tariffs on the US, so that'll lower prices or help at least on that front. And our economy is running in what we call a slack position. It's running below its potential space. So there's supply that's just sitting idle. So there's a number of factors that argue that if you cut a couple more times, it's not going to stoke inflation to any great degree, but it could be that little bit of incentive to push drivers on investment, reaccelerate the housing market, and other factors that help the economy recover.
And also, I guess, helping, I think if people think about the loonie, and I remember, I think people are kind of one of the things we preparing for is that the decades or the years of having a higher US dollar, lower loonie changing. This at least dampens that a little bit if they keep cutting rates.
Yeah, so it usually puts pressure on the loonie, and that usually helps you on the import side, right? So sorry, on the export side, because you look more competitive. So that's a possibility, but I think right now that when you look at how the currency is being driven, it's not so much on the interest rate differentials, it's more on just like the plain uncertainty, the risk environment that's happening, and like that embedded notion of safety.
Yeah. Interesting. Okay, housing. I said we were going to get to it. So last question, is Canada's housing market showing signs of life? Is this a flash in the pan? Is there something more to it?
No, I think it's got some legs to it.
Really?
We've now had about 4 months of sales recovering, making a steady pace. So that's a trend for economists. 3 is a trend, let alone 4. And it looks like what we may be seeing is when everybody hit the pause button in that like March, April, May period, when all the tariff uncertainty in the 51st state and everything was just in upheaval. Everybody just hit like, let's just see where this economy is going. Maybe feeling a little bit better for some segments of the economy. If you're in non-trade sectors, the job market still actually looks pretty good from that perspective. And you're in a relatively low interest rate environment relative to, let's say the US.
Yeah.
They have 30-year mortgage rates that are sitting over 6%. We're well below that in Canada. So you're starting to see, demand start to flow in. It doesn't mean that you get into this like booming market. Obviously, we know in places like the Toronto market, the condo market's very oversupplied. It takes time for that to come off. But I think this one has legs to it.
My last question that I didn't plan on asking you, but I'm going to ask you now. If you think about Canada, and we've only got about 90 seconds, what are some of the opportunities that maybe Canada should be thinking about as we reimagine the economy?
Yeah, so this gets a little bit controversial, I think, because when I propose it, we have been looking at partners and expanding our trade relationships with the EU and others, right? And shifting a little bit away from the US. And you can actually see that happening in the trade data as a share of our exports.
Already.
There's more going ex-US. So that's positive. We still don't have a repair on our relationship with China, and it would be peculiar to have, the US is 20% of the global economy, Europe 20%, but then you ignore the other 20%.
Right.
They're a very big consumer, and so there is an opportunity there for Canada to find some strategic partnerships where it makes sense. One of the areas we're thinking about is that although Canada has protected its auto sector by putting on very high tariffs of EVs coming in from China, and that makes sense because they're heavily subsidized in China, they are the most innovative in terms of their technology for batteries. And it would be a shame that we can't find a way to do a partnership maybe in the battery production domestically in Canada, so workers will be used in Canada. We already have all the critical minerals they need to produce their batteries, and because it's a market leader, and we can do it at a lower cost, it might also jumpstart EV production in general in Canada, where we are like, there's no way we're going to hit our EV targets as where we are today in terms of adoption on the retail market. So there's opportunities there. So I think you have to, again, like being the data dog, you got to go sniffing in all the corners. Don't ignore a corner just because there's a legacy of it. Maybe just pull it apart and see if there's opportunities.